Good morning and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSite, we have Bob Yawger. He's a senior energy analyst over at Mizuho Americas with our monthly energy report. It's been quite a month since I have seen you last, and it seems like we can't get that bid in oil. A number of concerns out there, oversupply, global growth. What are you looking at?
Well, we have had a couple of positive developments here as of late. The price still is threatening to go through $50, but we do have some things that have happened in the last couple of weeks that should help to support the market to a certain degree. The first one and the most in the press the most is the OPEC supply cut. They cut 1.2 million barrels of production, supposedly cut it. There was a lot of fighting and quarreling at the meeting, and all eyes are on what the numbers actually are. It doesn't kick in until January, so nothing has to happen at this moment. But 1.2 million barrels from OPEC, that was one of the big developments. Another big development was here in the United States, the EIA weekly reports had been positive. We were putting more and more crude oil into storage for weeks on end since September. However, in the last two reports, they've been negative numbers. And so we're starting to draw on storage. Now, that's a seasonal phenomenon that should have kicked in. It took longer than usual this year, but to make a lot of heating oil for heating season, you generally have to start taking crude oil out of storage, running it through the refinery at about 95% of run rate at this time of year, and that tends to equal a negative storage number.
All right, so we have a couple of positive data points, but again, global growth concerns out of China, out of Europe. That seems like a longer-term issue than just a couple of weeks of drawdowns in my mind. And of course, as you had said before, the cuts we saw at OPEC, potentially some from Russia. Is this all going to make a difference in the grand scheme of things?
Well, the demand side of the equation is getting wobbly. Mm-hmm. So that's something that folks really don't pay all that much attention to up until this point. But the global economy, this trade situation has really taken a hit at the demand scenario. So yes, it's become a big issue. It's really hard to attach a number to what the demand scenario is, because the actual crude oil numbers, the amount of crude oil going through refineries, especially here in the United States, is actually pretty good at the moment. But there is also, say OPEC, for example, they're going to cut production starting in January. However, folks will start to buy as many barrels as they can in front of that January date. So it makes it look like demand is pretty good when in fact they're just trying to front load the situation so that they don't suffer accordingly down the road in January. So it gives a false sense of security. Right. So yes, that's the situation that exists right now.
What about the U.S. rig count? You look at that as an indicator as well.
I do, and it is. However, it's not like what it used to be. There was a time when we had 1,600 rigs in the ground, and we were making about 2 million barrels less crude oil. We've gotten so good at it that basically, in very many circumstances, we can put 3 rigs. One rig can do the job of 3 rigs from 2-3 years ago. So the rig count falls back accordingly. Natural gas is another very good example. We have so much natural gas now. There was a time when the natural gas rig count was 1,600. Now it's about not even 200. And we're making more natural gas, bringing more natural gas out of the ground than we were then.
We've discussed this before, but the question is, why can't the U.S. be oil independent? It sounds like we're firing on all cylinders, but it matters of the type of quality of crude that we have, which does that mean it means we'll kind of always be dependent on other nations for that?
Yes, we did actually go oil independent for the first time basically ever 2 weeks ago. We exported more crude oil and product than we brought in for the first time ever. Last week we went back to an importer country. But yes, there's certain situations where it's better for an East Coast refiner. It's better for one of the refiners in New Jersey very often to take the crude oil, take a cargo from Nigeria because of the quality of that crude oil than it is to import or bring those barrels up from the Gulf Coast, to bring them up from Texas, for example, or to ship them by rail to New Jersey from the Dakotas. It's just cheaper. It fits the refinery match better. Our kind of supply and demand in the United States it works so well. There's very little constraints on shipping and things along these lines. We can bring a barrel from Nigeria as easy as we can bring it from Texas. And most countries cannot do that. Most locations cannot do that, and it benefits us greatly. The arb between the Brent and the WTI, the international benchmark, and the U.S. benchmark, it's at $9 right now. That represents a whole world of possibilities for U.S. refiners, for U.S. producers. We exported our most barrels of all time a couple weeks ago. Why would we want to why do we want to? If you're from, say, Rotterdam, you can buy U.S. crude for $9 cheaper than you can buy it from Nigeria. Why not buy that U.S. crude?
Right.
And folks are increasingly did that, and we broke our all-time export record.
All right, and to wrap up here, $50, that seems to be the line in the sand right now.
Yes, it has. We have not traded below that since we got the OPEC decision, 1.2 million barrel cut, but we haven't gotten too far away from it either. So we're really in this range from about $50.30 to about $53. I think personally that we will see upside. We will catch a bid here. This week's storage number will be a big event. I do think that we will eventually catch a bid that should get us to about $59, $60. And that's the direction that we will ultimately head in.
All right, Bob, thank you so much for joining us. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.